Hello, everyone. Today I want to tackle the topic of covered calls. The reason being is that in my last video, I talked about what I was doing this week in terms of selling covered calls on SoFi. I realized that this may be lost on some people who aren't familiar with the strategy, kind of the underlying fundamentals of it. So my hope today is to be able to share some of uh, the underlying principles in a kind of very, hopefully bite-sized manner so that it's kind of really easy to understand. There's already a lot of great kind of resources on this, whether it's through websites or whether it's through videos. My hope is to take a stab at it and make it as friendly as possible to understand. Now, if we were to go ahead and look up on Google covered calls, we could see that there's, as we said, it exists kind of a plethora of videos. Actually, one I tend to like is from the Plain Bagel. He's really good at it. He's really good at videos. Um, and then more formally, there's also kind of definitions in Investopedia. You can take a look at it, and it aptly describes what a covered call is, but it can be difficult to understand some of the terms. And for that reason, once again, I want to kind of take my own approach to it and make it as user friendly as possible. Now, uh, I do want to share that this is all based off of my self-study knowledge. I'm not a financial advisor. However, I did take some time to learn it from YouTube and from online resources, and I've been applying it as far as kind of my strategy, my own personal strategy for kind of investing. Now, um, once again, this it's not a financial advice, so always make sure to do your own research. If you feel that at any point maybe things that I say don't make sense, I always recommend kind of doing a second take, right? Looking at other resources and so forth. But let's go ahead and take a look at what our covered call or the covered call basics. I Initially I was going to start off with going over the steps of the covered call, how to perform it, and then giving some tips on it. But I realized that was the wrong approach because some people might want an outright definition at the start, kind of an overview of what it is. Afterwards, kind of looking at some risks and advantages, and then going into how do we actually write a covered call. So let's go ahead and start off with that definition. Now, this isn't as simple or this isn't as friendly, just because I want to make sure that it's available so that people who are familiar with it kind of have an understanding of it, and people who aren't familiar with it, hopefully by the end of it, will understand it. So the simple overview is that you have, by writing a covered call, by making a covered call, you place an obligation on yourself to sell your underlying shares, and what I mean by that is you first have to buy 100 shares, and then potentially you will be asked to, you will be forced to sell these at the strike price. We'll talk about what that means. And you'll be forced to do this in two conditions. One is if the contract holder, the person who buys it off of you, chooses to exercise their call, which means they're taking away your shares and and paying you back. So they're not just taking away your shares, but they have to pay you a certain amount, which is called the strike price. Or if at the expiration date, or if at expiration, the stock price is above the strike price. So if the stock price is above the agreed upon strike price, then they'll be forced away from you as well, and then you'll get thrown cash at you essentially. Now, you're getting potentially your shares taken away from you. You might actually profit on that because they might be taken away from you and they'll give you some more cash. We'll talk about that in a little bit. But what do you get? Because you're being placed within a contract, you have an obligation now. Essentially, your shares are being locked up for a period of time, and you can't really touch them necessarily. They're technically you can't touch them during that time, and you might be forced to sell them at a lower price. Say, for example, you choose the strike price of $7 and it goes up to $100. Well, you already chose $7. You can't get all that appreciation at $100. So you're capping your upside. So what are you getting out of it? In exchange for this obligation, right? So what are you getting? The seller or the writer, so you could say this interchangeably, of the covered call will receive a premium, or what I like to call a rent. Essentially, you receive a a rent, or a kind of like, imagine they give you money. They give you money for putting yourself in this position. And that's really what a covered call is. And so this is a really good strategy for me personally, and I just want to share this with you. So now let's talk about the risk, because I always like to get the risk out of the way. So what's the dangers of the covered call? Well, number one is it's very resource intensive. People consider this resource intensive because in order to sell one covered call, you have to have 100 shares. Covered contracts, right? Options, essentially options. They always happen in 100 share quantities. Almost always, not always, but there's always exceptions. So they happen in 100 share quantities. So you can imagine if you have like a $10 stock, and you want to sell a contract on it, you want to sell a covered call on it, well, that's going to require 100 of them. So 10 times 100, that's what? Sorry, $1,000. Yeah, no, 10 times 100, 1,000, 10,000. Wow, this seems. I think it's because I'm on there. Let me just let me just put the two zeros. There you go. A little nervous. Yep, $10,000. So for that reason, it's it can be resource intensive just to do a single um, covered call. So that's something to be mindful of. Wait, what am I saying? $7, 700, 7 times 100 is $700. 10 times 100, yeah, $10 times 100. That's going to be 1,000. Sorry, I don't know what I was thinking there. So that would be $1,000 if you have a $10 call. So or $10 a stock. Now, besides it being resource intensive, and please excuse me for earlier, sorry, I'm a little nervous, I guess. The other part is you limit your upside. What does that mean? When you select the strike price, what happens is you cannot gain any profit past that strike price. Kind of in the example I gave earlier, let's say if you gave a strike price of $7, so let's just say hypothetically, you get a strike price of $7, $7 like that. And let's say it goes up to $1,000 or $2,000 per share. Well, the most you can sell it at is $7, plus you'll get some rent or premium, but that's it. That's the most you'll get. So essentially, if it ends up going to the moon, like GameStop or AMC or any kind of those meme stocks that ended up kind of just, or like let's say Nvidia, right, that ended up kind of going up, incredibly high, you'll limit yourself. You won't be able to capture those gains. So that's another kind of risk in the sense. It's not necessarily money that you'll lose, but it's upside that you won't have access to anymore. And the third part is uh, this is an obligation that you hold for a certain period of time, a certain duration. It could be anywhere from like a week, as little as a week, to you can have it as long as about 2.5 years. So during that time, it's semi locked up and you can't really touch it in a sense. You can choose to get out of it early. Maybe we could talk about that, but essentially, you, to think about it simply, so once you enter into this contract, you kind of want to wait it out, and then that way you can assure your profit, your premium, your rent, you get that given to you certainly. Um, so what are the advantages? The advantages are you can make money even if the stock price is stagnant, so it's just not moving at all. This is kind of happening to SoFi, or even if the price is going down, you can still potentially make money. Depends on how down it goes. Obviously, if a company goes bankrupt, you're not going to make any money on that unless you're talking about buying puts, right? But we're not talking about that. But let's say if you're traditionally you just buy a stock and you're waiting to sell it at a higher price, which is what people normally do, um, then obviously you're not going to make money if the price stays flat or the price goes down. But in with the covered call, you can capitalize on a weekly basis, bi-weekly, monthly, whatever time scale you choose to, sell calls on. But you can actually profit during those times. So this is a really nice benefit. The other thing is that you can uh, profit more than you normally would um, from price appreciation. So let's say, for example, hypothetically, so this is just a hypothetical example. Let's say if you have a $10 stock, and let's say you decide to rent it out for 2 years. So you sell the covered call for 2 years, and as a result, they give you a rent of, let's call it $3 per share. Well, what happens here is, let's say you have this stock and you're okay with the strike price of $11. Let's just say that. So let's say in 2 years, what happens? Let's just go through a hypothetical. So in 2 years, what's the price? The price is, let's call it $12. $12. So what happens here is you bought it at 10 and your strike price is 11. So the most you can gain is up to $11 minus your 10, which is your cost basis. So you profited $1 in terms of stock appreciation. So you gained $1 from going to 10 to $11. But the price is $12. So technically you might be thinking, hey, I lost some money, because here in terms of stock appreciation, I only was able to gain $100 or $1, right? $1 to $100. We'll talk about that in a little bit, but I was only able to gain $1. When in reality, I should have gone up $2. But hold the phone, hold the phone. So in 2 years, you also, just for holding out that contract, they gave you $3 per share. So you get to keep $3 per share if you held this for 2 years, which we did. So in reality, there's two kind of outcomes. You could have just gotten, in this case, if you were just normally holding it, $2 of profit. But since you decided to sell your shares or sell covered calls on these, then in reality, you're not going to get $2 of profit. You're going to get the $1 of profit from your stock appreciating from 10 to 11, right? Because it's at $12, so you still get that $1 extra, plus the $3 of rent. So you essentially get $4 of profit. And this is twice the amount of profit, right? So you doubled your profit in the long run. And so while this one would have gained you, in this hypothetical example, $2, so 20%, in this case, you're earning 40% on your money. Right, so that's just one example of how the premium can help you. You can actually gain more than what you would normally get just from stock appreciation. So now that we kind of gone through that, I hope that made sense. I hope that it was somewhat clear. I know that we haven't talked about necessarily all these terms. Let's just go through the steps, and hopefully this will be a little bit more clear. So step one, very simple. Let's take a look at an example. You just want to buy 100 shares of a stock. For this example, I'm going to use SoFi. So let's say SoFi will want to buy 100 shares. Well, let's look at the price of SoFi. If we take a look at it, we see that it's at $6.97. So if I were to buy 100 shares right now, it's at $6.97. So that means, let's write this down, $6.97. And that ends up being, what do I need to invest? I need to invest $697 for one contract. So this is for one contract. Now what I can do is I have to choose a strike price and a date of expiration. Let's look at what a strike price means. So let's go to sell or trade options. By writing a covered call, you go to sell. You don't go to buy, you go to the sell, and you go to call. And so let's take a look at them. So the strike price here is pretty much what would you be willing to sell your shares for. So in this case, let's say I'm willing to sell my shares at $7. They'll pay me 16 cents per, this is the rent. This is 16 cents per share. Now, once again, each contract is 100. So while this looks confusing because it's 16 cents, it really means $16 because it's 16 times 100, so $16. So even though I invested $697, they're willing to give me $16 if I'm willing to sell it at $7. So I know I bought it at $6.97. I'm willing to sell it for 3 cents more, right? So $3 more effectively, and they'll pay me $16 here. So I could sell it like that. Obviously, there's a buy and there's a spread between the buy and the ask, or the bid and the ask. So I'm more likely going to get like $15, unless it goes up a little bit. But let's just assume I'll get $16. Now, this makes sense because it's very probable that within 1 week, the stock price should be $7 or above, right? The people who buy these options from you, they're hoping that it just rockets up to the moon, right? They're hoping it goes to $1 million so they can make tons of money. But you also benefit if it goes up, but you ideally would not want it to go up too much because then you'd miss some of that. Miss some of the gains. You don't actually lose money, but you'd miss some of them. But it's very probable that it'll go to $7. For that reason, they'll pay you pretty nicely, $16 just for a single week. So notice this 6 days. What if I'm only willing to sell it at $7.50? Well, that's quite a bit higher than the current price, right? That's quite a bit higher than $6.97. So they're not going to pay you $16. They're only going to pay you $4. What if I'm only willing to sell it at $8? Well, in that case, that's much, much higher than than this current price. So they'll be willing to pay you less because it's less likely to happen, right? It has to go up much higher in order for them to profit. So they're only going to pay you $2 per contract. Right, so that's something to consider. Right now, we're only talking about out of the money contracts. There's also something to be said about in the money, but we don't have to worry about that right now. So once again, we have to determine what price would you be comfortable selling away your shares. Obviously, if you pick the $8, well, you would be able to capture more of the appreciation. So let's say the stock did end up going up really high up this week, you would be able to capture 3 cents plus $1, so $1.03 of appreciation per share, so $103 effectively. But they only pay you $2 for that week. It's not a lot that you're getting back for locking up your shares, so it's not really worthwhile. Versus in this case, $16 for me, that's pretty worthwhile to get $16 for a single week, right? So you're getting that back, but I'm also making it so that the most I can sell this at is $7. So that's the strike price. Essentially, what are you comfortable selling your shares at? What price are you comfortable selling your shares at? The next part is, now that we talked about the strike price, is the date of expiration. This is when the contract or option will expire. So in this case, you could see 6 days. This is June 14th. It's currently June 8th. Obviously, if it's only a short amount of time, then it's less likely to fly up in a short amount of time than it is to fly up in a longer period of time. So say for example, if someone said, I think SoFi is going up to $10. What's more likely, that it goes up in 1 week to $10 or that it goes up in 2 years to $10? Obviously 2 years, right? Because you have more time for it to make its movements and do its thing, right? Just in terms of volatility, the stock market as a whole goes up, so then maybe this stock goes up. So you just have a lot more time, which gives it a lot more opportunity for it to reach a certain price. So because this is such a short period of time, they're willing to pay you less. So if I say, for example, if I think it's gonna go to $8, they're for a single week, they're only gonna pay me $2. But if I were to go to 2 weeks, how much would they pay me? So now 2 weeks, so on the 21st, they're willing to pay me $4. So you can see as time goes out, you're getting paid more and more money. So in 2 weeks, that's $4. Let's talk about 1 month, which is around this time. Here we see $8. They'll be willing to pay us $11 of rent. Now, as we go further out, let's talk about January. In January, they're willing to pay me $96. So you could see that the farther you go out, the more money in general that they'll give you for being willing to pay, or being able to willing to lock up your shares, right? Sell the covered call. Obviously, the closer it is to its price, the more money they give. So in this case, $7. Look at this. They're willing to pay you $132. But if you're willing to go to $8, they'll pay you less, $96 and so forth and so forth. So let's say if you're only comfortable selling your shares at $10 in January, then you could still be paid $50 per share, which is pretty nice because it's a good percentage of the $6.97. So the whole purpose of this is that there's really two factors when considering the premium or the amount of rent that you'll receive if you choose to sell your sell a contract on your shares, and that is the strike price. At what price are you comfortable? The closer it is to the strike price, the more it is, and also the date of expiration. The longer the date of expiration, so the more time, the more they'll give you. Not necessarily more per unit time, but the more overall that they'll give you. Okay, and that example we saw earlier, right? $132 is certainly more than the 1 week and the $16. So now that we understood those, what do you get again? You actually get this as your premium, as your rent. So as soon as you sell this, so if you buy 100 shares and then you choose to sell this, so you say sell call and then you write this option, you receive automatically right off the bat $16. So it is yours, kind of. What I mean to say is it is yours as long as you choose to not touch this, not touch the stock, not touch anything until it expires, until you wait until expiration. Once it gets to expiration, this whole $16 is fully yours, completely yours. And then you just have to base off, depending on what the price is at the end of that time, then that'll affect your overall profitability. But this $16 will certainly be yours, or will be mine in this case, because I sold some covered calls, as long as I wait to the end of June 14th. So I'm guaranteed to get it because I sold it already. So this is guaranteed already. So I want you to think of it this way. This is a way I like to describe it. Let's imagine that you're renting an apartment. So that you rent an apartment. And let's say that, so you're the person who owns the home and you rent it out to someone. And let's say you pay $1,000, or the rent is 1K per month. Now, in this hypothetical example, the people who rent it from you, they pay you 12K for the year. They just pay it to you. So my question is to you, if a person, if the people moving in paid you as the landlord 12,000 for the year, let's say on January 1st, they pay you 12K, is that money yours? No, right? It's not technically yours until time runs out. So after 1 month, how much money is yours? So after 1 month, 1,000 is yours. You earned $1,000. Why? Because 1 month has passed, and that's allowed the contract to depreciate, the landlord contract, the sublease or the lease, whatever it may be, to depreciate, and now it becomes yours because you've allowed them to live in that place for 1 month. Let's say after 2 months, what happens? So this is just a simple example. So now 2,000 is really yours, right? And after 10 months, what happens? Well, 10,000 of it, 10 of the 12,000 is yours. What happens after the full year? After 12 months, all 12,000 is yours. Now what happens? The contract, the lease is over. You've given up your obligation. You no longer have to have them in your home, and you receive the full $12,000. That's the equivalent of this idea. So for this time, for this 1 week, I put an obligation on my shares, but I received $17 technically. So I received $17. And as long as I wait it out for the full week, then afterwards, no matter what happens, I have no obligation. I fully, the contract expired, and I'll be guaranteed my $16. I receive it up front, but it's not technically mine until I let the time run out. I hope that makes sense. Now, the next thing we want to talk about is determining the profit. How do you determine the profit with these? This can be confusing for some people, but let's go back to our example with SoFi. We want to start off with cost basis. So what is our cost basis per share? Well, we bought SoFi at $6.97. I want to put this over here, $6.97. Now, which one are we going to sell? Let's sell this for the week. Let's do $7 strike price at June 14th. So these two together tell me what premium. So I get $16 off. So let's go back to my notes. So for the $7 strike price, of $7 for June 14th, I get a premium of $16, $16 of rent. So what does that mean? We have to subtract the $16 from my cost basis. So $16 or $697 is roughly $697 is what I paid. I have to subtract. Technically, you could do it this way. You can subtract the 0.16 cents, or you could choose to subtract the $16. Right, and regardless, what do we get? We'll get we'll get $6.81. That's my new cost basis. Or notice I would have only paid for 100 shares, $681. So we could think of it in these terms. So if I paid $6.97 per share and I was given a rent of 16 cents per share, that means my new cost basis is $6.81. So I want you to think of it that way. What's your starting cost basis? Subtract the premium, and this is your new cost basis. Okay, so this is your new cost basis. Now, I want you to imagine 3 scenarios. So what are the 3 possibilities? You could be in the money, which is above 7. In this case, above $7. You could be at the money, which is at $7. Or you can be out of the money, which is less than $7. Less than $7. Let's consider these 3 scenarios. So let's imagine that let's just imagine that the price is $200 a share. Let's just imagine it went up really sky high. Well, the most that you could sell your stock for is $7. That's what a strike price of 7 means. That means the most you can sell it is for 7. So if you choose to sell it for $7 strike, and your cost basis, your new cost basis is $6.81, then effectively, how much are you profiting? You're profiting 19 cents per share. So that is being 0.19 per share, or $19. So in 1 week, the most you'll make is $19. If it's above $7, so it's $200 or $300 or just $10, $9, $8, doesn't matter. As long as it's above $7, you'll make 19 cents per share or $19 according to this, the way we laid it out. Now, what if it's at the money, which means it's at the strike price in this case? So it's exactly $7 a share on June 14th at 1 p.m. PST. Then, so given that, again, we have a $7 strike price and your new cost basis, again, is 681, well, again, you're forced to sell it. So you're forced to sell your shares at $7. So once again, since you sold it at 7 and you bought them at 681, what's the difference between the two? 0.19 per share or $19. So if it's above 7, you make $19. If it's at 7, you make $19, the full profit. Now you might be asking, what if it goes down? So let's imagine it goes down to $6, hypothetically. $6 a share. Well, if it goes down to $6, your strike price is still 7. The thing is is the share price above the strike price or at the strike price? No, it's below it. So because it's below it, you're not forced to sell. Not forced to sell. You're not forced to sell because it's below the strike price. So what that means is you keep your 100 shares. The original 100 shares that you bought, you keep them. So you still own your shares. But now the price per share is $6. So what happens? So you have the $600, which it currently is. It's at $6 a share, so it's 600. Plus, remember, you made how much was the rent? $16. $16. So you're at essentially $6. Sorry. So you're essentially your new equity, the amount of money that you have is $616. $616. So you have $616, but you spent $697. So you actually are at a loss. So you might be saying, okay, so this is at a loss. These are at a gain, right? These you gained $19 plus 19 plus 19. And this one is if you're at 616, but you started at 697, how much did you lose? Minus 697. 697. You lost $81. $81. Right? Yep. Yeah. So you lost $81 there. At what point do you break even? At what point do you break even? Well, it's going to be whatever your new cost basis is. So whenever we said our new cost basis is 681 a share. So let's say at the final date of expiration 614, it's 681. Well, what happens here is you just broke even because this matches your new cost basis. So at 681, even though you bought it at 697, at 681 you broke even. You neither gained, you neither lost. So this helps you because let's say you were going to hold on to this stock no matter what for the week. Well, instead of being at a loss at 681, now you're broken even at 681. So do you see how it could help you in terms of minimizing your loss or even gaining a profit? Because let's say it went to 685, hypothetically, let's say it went to 685. Well, you just profited $4 because you're 4 cents above your new cost basis. Right. So this just goes to show in terms of it being flat or it going down, you could definitely still profit. So what are some things to know? What are some things you might want to know for this? Well, number one is that shorter expirations give you a greater unit per time or give you a greater return per unit time. What does that mean, right? So obviously like that sounds a little bit confusing, but what does that mean? So we can assume that this is 1 week. 1 week from now, I'm willing to sell the $7 strike for $16. For 1 week, I'm getting $16. Let's say I do 4 weeks. So 1, 2, 3, 4. Am I getting 4 times 16? No. Look, if it's 1 month out, which is 4 weeks out, I'm only getting $34. I'm getting about half of what I would get for 1 week. I'm still getting more money, right? So I'm still getting $34, which is not bad. But if I just did weeklies, you would get more per unit time, right? If you can imagine 16 times 4, that's above $34, right? That's $64. So this is good in terms of flat prices or prices kind of going down. That's when you would want to sell your covered calls. Now, the reason why you would want to do longer, generally, a person, why they would, like for myself, why I would want to do longer contracts is because you get to lock in this price. So let's say if I want to wait until January, per contract, I'm getting $1.32. That's really good. That's a lot of premium. And this fluctuates as the price changes. So I might not be able to lock in this price. Let's say it flies up above. I won't be able to lock in this price in the future. Or let's say it goes really low. I won't be able to lock in this price. So at this moment, I can lock in this solid price because it's close to $7. So that's one thing to consider. That's why people might be more open to doing selling covered calls for longer term than shorter term. Some people might also want to do shorter term because they're able to get more profit per unit time. Right? It just really depends on what you're going for. Now, in my case, I'm choosing to do a weekly because that's quite a bit of money for a short amount of time. Now, the other thing I want to stress is volatility. Volatility is the fluctuation of the stock. Right? Think of it kind of like standard deviation, like variability. Um, this happens, so these prices increase, or whenever the stock price will generally become more volatile, or things for the stock become more uncertain. So you can imagine during earnings every 3 months, right? Um, a stock will become more uncertain because they don't know if the earnings are going to be good, neutral, negative. So for that reason, the options become more expensive. Okay, so in times of uncertainty, these will have an increased rent. Another example is, let's say, for example, during, let's say, the Fed cut, the Fed meetings, whether they're going to increase interest rates, decrease interest rates. These might also become a bit more expensive because people are betting on what's going to happen. They're betting it's either going to go up, in which case they're buying calls. People are going to bet that it's going to go down, in which case they're buying puts. Regardless, it's increasing the volatility, and that makes these more expensive, which is better for people who are selling calls or selling covered calls because they get to capitalize on these higher prices. Now, the next point is generally, so this is just me personally, I only do these on solid picks at an undervalued price point, or I like to think I only do these on solid picks at an undervalued price point. And that's because you, as the person who bought the 100 shares and sold the covered call, I'm only getting $16 for the week. But I spent, in this example, hypothetical example, I spent $697. What if this stock goes bankrupt? Well, I'm left with the $16, but I just lost $697, right? What if it's not a solid pick? Well, then that's pretty terrible. You're going to lose a lot more than you're going to gain from these um, rents or premiums. So you have to make sure it's a solid company that I believe will do well in the long run. And I also had to make sure that even if I have to make sure that it's at a solid price, so that even if it goes down, I don't think it'll go down that much more. Or if it does go down, I can buy more of the stock and sell more contracts. Right? That's something to consider. Now, the last part I want to say is that there's always the option to buy back your contracts. So, as an example, if I go back here, I sold these for $17 a piece, but I could choose to buy it back for $16 a piece. So that's why, so even though it hasn't reached the date, I can buy them back for a profit of $125 already, because I can buy them back for 16, but I sold them for 17. So I can say, okay, here's your money back, but here's less money, and I can gain a profit. Why is that? Because in this case, two things have happened. Number one, a day has passed, kind of time has passed. So as time passes, this becomes less valuable, and I'm able to buy it cheaper, buy it back cheaper from people. And the other reason is because the stock price has gone down a little bit from when I sold that contract. It was at 702 when I sold the contract, but now it's at 697. So as the price goes in the opposite of the direction of the contract, so if it's a call, let's talk about just calls. If it goes down, the price of the contract also goes down. If the stock price goes up, the price of the contract becomes more expensive. Right. So That's just something to consider. So you can always exit out early, but we don't really want to talk about that. That goes more into practical examples. We would have to see that in place. It can be a little bit confusing when you mix in like volatility with like price appreciation or price decreases and so forth. It definitely takes some practice to kind of navigate it and feel like more comfortable with it. But if we just keep it to the simple basics, which is you buy 100 shares of, I buy 100 shares of a stock, I sell it at a certain strike price and a certain date, and then I just wait it out. And I do this with solid picks that are undervalued. And then that way I'll be able to collect my premiums. And if it's above the strike price, so be it. They take away my shares and they give me, a lot of cash. That's essentially what it is, what it breaks down to. This is the strategy that I tend to favor. Once again, these covered calls, for me, it helps minimize risk. For me, it puts me in a more comfortable position. That's the kind of strategy that I like. Some people like to buy calls, right? They like to be gamblers about it, which is one way to, I guess, invest. Um, this is just some information. I hope that you found this enjoyable. I hope that you found this informational. Once again, this is not to say that you should be doing this. This is just kind of another, interesting topic that I thought I'd talk about. So I hope that this makes sense. Please let me know if you're interested in learning more about, my own personal stock venture and stock strategies that I'm aware of that I self-studied. If so, please like, share, and subscribe. Thank you so much for watching, and I hope you have a wonderful weekend.